Have you ever wondered how early-stage companies, those without significant revenue or traditional financial track records, manage to secure funding and establish their value? It can seem like a mystery to place a price tag on potential, yet there is a structured approach that many investors relying on. The Scorecard Valuation Method is a widely used technique primarily for valuing pre-revenue or early-stage startups. It works by comparing the target company to similar, recently funded startups in the same region and industry, then adjusting that benchmark valuation based on specific qualitative factors unique to the startup being evaluated. This method provides a clear, systematic way to assess a young company's worth. This method gains its authority because it acknowledges the qualitative nature of early-stage investing, where traditional metrics like earnings are non-existent. It starts with an average pre-money valuation for comparable seed-funded companies in your market, and then systematically adjusts that average. The core idea is to evaluate several key factors of the startup against what would be considered average for that market, assigning percentage adjustments. Each factor carries a different weight, reflecting its relative importance to investor confidence. For instance, the strength of the management team is often weighted highest, as experienced founders are crucial for navigating early challenges, while other elements like the size of the market opportunity and the uniqueness of the product or technology also significantly influence the final valuation. To effectively leverage this information, founders should meticulously prepare to demonstrate strength across these identified factors. Understand that investors using this method will be looking for how your team, market, product, and strategy compare to the average successful startup they have seen. By proactively addressing potential weaknesses and highlighting your competitive advantages in each category, you can influence the percentage adjustments positively. For example, if your management team has prior startup successes or your intellectual property is particularly robust, these are strong points to emphasize. An interesting nuance of the scorecard method is its flexibility, allowing it to adapt to different market conditions and investor preferences, while still maintaining a logical framework. It is less about precise numbers and more about a structured assessment of risk and potential. This qualitative approach helps bridge the gap where quantitative data is scarce, providing a common language for founders and investors to discuss value beyond just financial projections. Ultimately, understanding the key factors of the scorecard valuation method empowers you to strategically position your startup for investment. By focusing on building an exceptional team, targeting a sizable market, developing a strong product, and planning clear go-to-market strategies, you are not just building a better business. You are also intrinsically increasing your company's perceived value in the eyes of early-stage investors.